but the currency is not of the home currency. In Germany, the home currency is euro, but they are issuing in dollars, right? So this is called euro bonds. So denomination are commonly in a number of currencies. There is underwriting process. What does it mean? Those companies are called underwriters who facilitate the issuance of the bond, and also they are entitled to participate in the bond as well. For example, if the bond is paying you 7%, you think that this is lucrative. So the companies who are also facilitating you to issue the bond, they can also buy the bond. Or if the bond is not fully paid, so they can also ensure that we will be purchasing the rest of the bonds if the bonds are not fully paid. So they can also float this bond into a number of countries as well. For example, if Apple company needs $200 billion, so they issue bonds which is in US dollar, also in US, in Germany, in UK, in Japan, so that they can have $200 billion in less than 6 months. So this process of helping the Apple company to issue bond is called underwriting process. And also the underwriters, they can also purchase some of these kind of bonds as well, or the underfunded bonds as well. If for example all these countries they satisfy 190 billion, so they can say that we are ready to the underpaid amount of $10 billion, we will be facilitating you, and we will be they can have their own arrangement as well. We will be charging you higher interest rate and etc. Secondary market is a market where the the bonds are sold and purchased for the second time or after its issuance. So when the first time is issued, we call this primary market, and after the sale purchase is called secondary market. So the market makers are in many cases the same underwriters who sells the primary issue. So the underwriters also purchase this 10 billion, and they can also afterward they can say that, "Okay, look, we satisfy." And for example, this was in 6 months. So after 6 months, they can just go to the market. They can sell that. Okay, we have $10 billion worth of bonds. Who wants to buy? Right? The sale and purchase can go. Also in US or Germany, they can also trade these bonds to some other companies as well. Okay, we have this bond and we are ready to sell this bond feature is that you will receive interest payments twice a year, and it is maturing after 5 years or after 3 years, just like that. So there is a whole calculation of the value of the bond. So in secondary markets, already issued shares and bonds are traded. So development of the other bond markets, there are bond markets in Asia and South America as well. So bond market yields among countries tend to be highly correlated. So for example, the bond market yield is correlated over time. What does it mean? It means when the economy's conditions are weakened, what happened? The demand for the funds decline with the decline in corporate expansion. And when the when the economic condition is strengthened, aggregate demand for fund increases with the increase in corporate expansion. It means if you issue the bond when the economic conditions are strengthened, what does it mean? You can easily gather this money. Why? Because economy is booming, and this concept you know is known by major banks and investors as well. They know that this company is linked to the economic performance of the country as well. If economy is booming, then its business will also boom. So our money is safe, we can lend you the money and enjoy the appropriate interest income as well. What if economic conditions are weakened? Then you may not be able to gather money. Why? Because investors and banks, they are also educated. Over there they hire many international financial managers or financial managers and CFOs. They know that the company is linked with the country performance, and if the country performance is not good, if country economic condition is weakened, it means the companies perform companies demand for the expansion will go down, and we may lose our income and our principal as well, right? Plus, in the secondary market, if companies bonds are traded in which market, in which country where there is economic strengthen, then over there the primary market sale purchase will be higher. People are ready to purchase the bonds, ready to sell the bonds, just like that. But when the economic condition is weakened, the primary market also not function well, because there are people who want to sell, get rid of this company's bond, right? And the buyers, they will say that, look, this company is not doing good because there is a recession coming or economic condition is weakening. So there's going to be a hoard in primary market, that there's going to be a little increase or decrease. There is a little buying and selling of these bonds in the market. And why is that? Because corporations, they sell goods and services to the consumers, and consumer income is decreased when there is bad economic condition, so people cannot afford the products of the company that made. So company will be struggling with this you know liquidity issues, so they are not even paying the interest payment. Then what are the chances that they will be paying back the principal? So this risk is going to be even bigger when the countries are in bad economic conditions. Okay, now the risk of international bond. Number one is credit risk. So credit risk represents the potential risk for default. Interest rate risk, potential for the value of bond to decline in response to raising long-term interest rates, right? You book your money for 10 years at 2.5, but you see that after 2 years the interest rate gone to 6%, but you have locked your money for 10 years for 2.5. You could have earned, if you hadn't you not lent that money, you could have earned this 6%. This is called interest rate risk. Credit risk is that the company is not able to pay me the principal amount that I paid him, right? Third, the exchange rate risk. What does it mean? The exchange rate risk is only occurred in international bond, not the local bond. The local bond, there is no currency like is a there is no two currencies that gonna be exchanged for one another. In that case, the local bond, they don't have this exchange rate. So this is the risk that is represented by the it represents the potential for value of bond to decline because the currency dominating the bond depreciate against the home currency, right? For example, the bonds is mature in US, you buy the US denominated bond, and what happened? The US currency, the dollars, is depreciated, and when you convert back into your home currency, you will receive lower amount of money, right? So this is called exchange rate. Or you can say that you are receiving the interest payments in dollars, and what happened? The dollar depreciate, so you are converting dollar into your home currency and you are receiving less amount of money. This is also called exchange rate risk. Liquidity risk, which means the potential for the value of the bond to decline because there is not a consistently active market for the bond, which means if you want to sell that bond, there are no more, or there are less people who want to buy it. We call this liquidity as risk, which means ability to convert into cash. So ability to convert into cash of this bond is lower when there are less people who want to buy this. So you bought this $1 million bond and you want to sell. If you have some kind of need, if a need occur and you want to sell that bond, and there are fewer people or no people over there to buy this $1 million bond, even though this bond still pays you the amount of interest on time and all those stuff, but there aren't many people who want to buy this. We call this liquidity risk. So these are the risks that are, and the so this credit risk is interest rate risk, liquidity risk. They are borne by also the local bonds, as as well, risk to the local bonds as well. In addition to the exchange rate risk, is the only risk that is for international bond. In addition to this, credit, interest rate, and liquidity risk. Okay, let's talk about the impact of Greek crisis on the bond, and we will connect this topic with the risk to the international bond. So what are the risks to the international bond? The credit risk, exchange rate risk, liquidity risk, and number 4 was interest rate risk. So what happened in spring 2010? Greece experienced weak